Welcome back to the module on banking. We are now stepping into our last learning goal. In this learning goal, we'll try to understand what are four key features of a fixed deposit plan in a bank, and we'll also understand 6 parameters that you look at before you invest in the term deposit of a bank. Let's begin with the features. The first important feature is that the interest payment on a term deposit, and I'll use the word term deposit and fixed deposit interchangeably. The interest rate on a term deposit is a function of time. It's a function of the tenor of the instrument. It's a function of the holding period. The rough thumb rule is that shorter the period, less is the interest rate. Longer the period, more is the interest rate. However, in practice, what happens is that the interest rates go up from what it is for 15 days to what it is for 1 year to what it is for 2 years, maybe to what it is for 3 years, and then drops down. The logic is possibly that banks don't want to lock up deposits for an extended period of time. The second important feature of a fixed deposit is that this interest payment can either be cumulative or it can be non-cumulative. If it is non-cumulative, then it is paid at the end of every year normally. It can also, according to what the bank decides, be paid at the end of every quarter or at the end of every half year. In a cumulative plan, the interest is not paid out. The interest is added back to the deposit. So if you were normally under the non-cumulative plan, if you were being paid out every quarter that interest amount will now get added to the principal and it will only get paid on maturity. The advantage of a cumulative plan is that you begin to earn interest on interest. The power of compounding that we talked about in one of our earlier modules. The arithmetic and compounding that you did in school will now begin to operate. However, if you need your interest amount to meet your day-to-day living, it will be a good idea to have a non-cumulative plan. But if you don't need that money, it's wisest to go in for a cumulative plan. A third important feature of a bank deposit is that you cannot withdraw money ahead of time. If you withdraw money ahead of time, a penalty is likely to be charged for early withdrawal. Let me give you an example. Let's assume that you have placed a 3-year term deposit, and let's assume that the interest rate is 6%. Now you want to withdraw it at the end of the second year. What the banker does is that he looks at what would have been the fixed deposit rate for the 2-year period at the time when you originally took the deposit. Suppose it was 5.5%. Then for this 2-year period, he does not pay you 6% because that was meant for a 3-year term deposit, but he decides to pay you only 5.5%. He doesn't even pay the 5.5%. Because you withdrew prematurely, because you withdrew early, he might knock off 0.25% as withdrawal penalty and pay you only 5.25%. So it's very important to know how long you can actually keep a deposit with the bank so that you can invest appropriately and not lose interest on the sum. A fourth and last feature of a fixed deposit is that you're actually eligible for a loan against the deposit. You might get, depending upon how the bankers decide, anywhere up to 80 to 90% of the deposit. So if you have placed a deposit of 1 lakh with the bank, and let's say it earns you 6%, and let's assume that you can take 80% of the deposit as loan, you will get 80,000 as loan. You will continue to earn your 6% interest on the entire 100,000, but the loan that you took will attract an interest normally of the interest rate of the deposit plus 2%. So you might actually technically be earning 6% on the 100 lakhs and be paying out 8% on the 80,000. Now you might argue, and possibly rightly so, as to why should I pay interest on my own money? Why do I not withdraw that money and use it up? You can do that. But there are many people who feel more comfortable if they have an asset backed in the bank. Do you want to do that? Or do you want to break the deposit, take the money and use it for your conspicuous consumption? Is a matter of individual choice. Let's move on to our next segment, where we try to find out what are some of the things that you should look into before you actually go and place your hard-earned money into the term deposit of a bank. You may not be a very accounting-oriented person, but it's important that you need to look at a few parameters, or what in the world of accounting is called a few ratios, that help you check prima facie whether a bank is good or not so good for investment. The good news for all of you boys and girls is that these ratios that I'm going to talk to you about do not have to be computed by you. Today, as you're aware, there is a wealth of credible information on the internet. You just have to log on to a credible source and find these out. Here are some of the key ratios that you must look into before you decide to put your money into the term deposit of a bank. The first key ratio that you must look at is what is called the gross NPA ratio. The acronym NPA stands for non-performing assets. In simpler language, these are loans that the bank has advanced to customers which are unlikely to be paid. There are different stages of NPA. We don't have to get into the details of that. It is enough to know that if a loan portfolio is on NPA, it means that there is a significant incidence of that loan going bad. So it stands therefore to logical reasoning that higher the ratio of gross NPA to total asset, the more risky is the bank, because it means that the bank has been tardy in the manner of lending money to third parties. There are some banks where the second ratio that you must look at is the ratio of net NPA to total assets. Net NPA is gross NPA less provisions made. Provision would mean that much amount of profit has been deducted and provided for in the books of accounts towards the debt going bad. If you're someone who does not have an accounting background, I need to explain this to you. Let us say I lend 100 rupees and I expect that amount to go bad. It's not yet gone bad, but when it goes bad, that loan, which was an asset in my books of accounts, will now become an expense, which means it will reduce my profit. So I might decide that instead of all the 100 rupees getting debited to my profit and loss account in one shot, I might like to provide for that eventuality taking place, and therefore might debit my profit and loss account with 25 rupees in the current year itself. This is called provision. So at the end of this year, the NPA, which has still not gone bad, which is 100 at the gross level, will be shown as 75 at the net level. The more the net NPA to total assets, the worse the bank is. A third number that you look at is a number that the bankers called CASA, C-A-S-A, current account savings account ratio. It's the ratio of current account plus savings account to total assets. The interest paid on savings account is very small and the interest on current account is zero. So on the liability side of the balance sheet of a bank, if there is significant amount of current account balance and savings account balance, it means that a significant portion of debt is coming from low cost sources. So the higher that ratio, the better it is. A low CASA ratio suggests that the bank has not been efficient in procuring money, and this will therefore increase its interest burden and will hence affect the net profit. The fourth ratio that you must look at is called the net interest margin. I guess I forgot to tell you, for a bank, the raw material is money, the finished product is money. Let me explain. A bank raises money from you and me and lends that exact same money to people like you and me. Suppose it pays us 5% as interest, and suppose it lends to others at 11%. Then its net margin or its net interest margin is 11% minus 5% is equal to 6%. That is why the lower the CASA ratio, the less is the net interest margin for the bank. So you should look at what is the bank's interest margin. Higher the bank's interest margin, the better it is. The fifth and last number that you should look at is called the capital adequacy ratio. This is a very technical term or technical computation, and so I'll try to keep it as simple as is possible. Capital adequacy ratio is the ratio of a bank's total capital. Its tier 1 capital plus its tier 2 capital to its risk weighted assets. In more simple terms, what it means is that the total capital of the bank on the one side has been lent to various parties, has been invested in various investments that have different risk proportions. And after taking into account the weights for those risk proportions, which the RBI indicates to the bank as to what would be the appropriate weight, the capital adequacy ratio is computed. The higher the capital adequacy ratio, the better. For your perspective, it is suffice to know that if the capital adequacy ratio is anywhere about 10%, it's good. Let me quickly summarize. The 5 key numbers to look at are gross NPA, net NPA, net interest margin, CASA ratio, and capital adequacy. Lower the gross NPA, the better. Lower the net NPA, the better. Higher the CASA ratio, the better. Higher the net interest margin, the better. Higher the capital adequacy, the better. Ladies and gentlemen, boys and girls, now that you are armed with reasonable information in terms of what to look at before you invest your money in a bank, it's time for you to put this to action. Before I close out, I would share with you an exercise which I want you to perform. I want you to identify 10 banks, and in respect of each of those 10 banks, I want you to put out these 5 ratios. Google, search, hunt, and get these 10 into 5, 50 numbers. Based on those 50 numbers, you then decide how you would rank these 10 banks. Do that and share with us. We'll let you know how well you have done. Let me very quickly summarize the final leg of our final module. We talked to you about key features around a fixed deposit. We talked to you about interest. We talked to you about tenure. We talked to you about cumulative and non-cumulative interest. We talked to you about loans on fixed deposits. And then I walked you through 5 important numbers that you can look at before you invest in a bank. Happy investing. Thank you very much.